Good afternoon, everybody. I welcome you on behalf of Axis Capital to the Q3FY18 Eris Lifesciences, represented by Senior Management Team, Mr. Amit Bakshi, Chairman and Managing Director, Mr. Himanshu Shah, Executive Director, and Mr. Sachin Shah, Chief Financial Officer. Over to you, sir.
Yeah, thanks, Prakash. I'm sorry, it's a holiday for the markets today. I'm keeping all of you held up here. Just quickly want to run through the numbers. The numbers are on a standalone basis. The revenues have grown by 8.5%. On a consolidated form, the revenues have grown by 13.3%. The EBITDA growth is 12% and the PAT growth is 10% compared to the last quarter of last year. The major highlights of this quarter was that we were quite busy doing the integration of Strides, and so there was a lot of work to be done from a manpower, from a distribution point of view. All of that is now under control. We are looking forward for the next quarter where things would come up. Prakash, you can open for questions.
Sure, sir. Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. We will take the first question from the line of Mithilesh Sahani, individual investor. Please go ahead.
Hi, morning, Amit. This is Mithilesh. I'm an individual investor based out of UK. Congratulations on the successful completion of the Strides acquisition. My question was with respect to our company's overall CAGR for FY13 to FY17. Whilst it is higher than the industry for most of the therapies, can you please throw some light on the reasons why the growth is lagging behind the industry for vitamins and gastroenterology therapies?
For vitamins and gastroenterology therapy. Okay, so it's a little wide question, but I will just try to answer this because, the way the vitamins are therapeutically put in IMS are a little different from how do we put them in the divisions, within the divisions. So, the primary reason of this not so good growth has been the price revision which has happened in a product called Tio. So there was almost a 30% price revision which happened, I think, last year, and it actually happened twice in 2 quarters. So that's where that's the hit which we had taken on Tio, which is one of our leading brands in the space which you were saying, and that is primarily responsible for that subdued growth which you are seeing. As far as gastro is concerned, we have spoken about that in the earlier calls also, that the acute therapy in the last 3 years haven't shown the CAGR, which is well represented in the market in terms of growth rate ahead of the market, and there was some work to be done which is in progress.
Sure. Okay. Thanks a lot.
Thank you. Thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may please press star and 1 at this time. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question is from Prakash Agarwal from Axis Capital. Please go ahead.
Yeah, sir. I mean, you had a very brief commentary on the opening remarks. If you could just, speak more about, you did mention that you were busy doing, integrating the Strides acquisition. But if you could throw some light on which are the new segments that you launched apart from this, over the last 9 months, and what's the outlook for the Q4 and the year forward?
Okay, Prakash. So let me expand on what I started saying. For this year, there has been two things. One has been, for the industry widely, which has been the effect of GST and the disruption with GST cost both in terms of inventory and also in terms of realization cost. As all of you are aware, that the realization costs are now 7% less than with comparable years, comparable quarter. So for that purpose, anything which you read, simply adding 7% will bring it like to like. So that's one which is more of an industry issue. The second thing which is very important to us was the Strides brand which we brought, and how did we start integrating them. So as you are aware, I have told you in the last meeting also that we didn't took everything which we got from Strides in terms of people and distribution. Strides had a very wide distribution, and we thought that adding such a wide distribution to our channel might dilute overall the process of sales which we have been doing from a long time. So we cherry-picked distributors across with consultation of outside important people, and that was the process which we started in the month of December. So there was a lot of work which had gone down in the distribution channel. To give you a flavor of this, before the Strides acquisition, we were roughly around 1,300 distributors across the country, and roughly 1,000 to 1,100 were actually active distributors, wherein there was certain amount of sales which was registered during the year's time. As of now, we stand to be at around 1,500, 1,600 number. And most of them, these are all active distributors, I'm saying. So the non-active still remains 100, 150. So from a 1,300 core distributors, we have now moved to close to 1,700, 1,750 distributors. So that was a big job which we had done. The good thing is that there is a clear-cut bifurcation in terms of A, B, C in the overall value which a stockist bring in terms of the market which he services. So clear-cut, there has been enough data in the industry which says more A-type stockist you have, the better is the coverage. Not only in the major town, but also in the associating towns. So we have been able to add a lot of A-category distributors, which we believe will help us open up the channel in the coming time. The second biggest issue was the people issue. So you remember I told you that we had this portfolio was being promoted roughly by 1,400 to 1,600 people in Strides. You pardon me for 5%, 10% here and there. And we actually took somewhere between 250 to 300 people. So we went through the entire process of talking to people and getting through. That was the deal which we had with Strides. So these were two important things which we went. Now what has happened after Strides? So you remember we told you that we have opened up one neuro division with 65 people. We got a good portfolio from Strides. Some of them were not very big in size, but were very important therapy areas, good therapies to remain and consolidate. It actually gave us an idea, first of all, to move that 65 people to around 100 people, and then also add one more field force, because we got that human capital in neuropsychiatry with Strides. A lot of people there were experienced people who had experience working with the same portfolio with the previous companies. So we not only expanded our one division, but also added one more division of around 130 people. So that's one change which happened. Now, neuropsychiatry, the volumes as of now remains where it was, but the kind of promise which we have added in terms of market size, addressable market size, is quite significant now. So these are all the things which we need to work out in the next couple of quarters and pan out. So that's one. we got one very good brand in terms of Radicap, which was in the women health section, and that also prompted us to add up certain people in the gynecology or the women health team. So the women health team, which was around 160 people, actually now got expanded to 220 people, and that is the reason, Prakash, if you look at quarter to quarter, there has been a 10-11 crore increment or maybe 30% increment in the HR cost. That has all happened because of these new people who have come in. So as typically what happens in these kind of acquisition typically is you get the people first, and then you get the brands, and then you get the sales of the brand. So because the people came in first, you see that impact on the P&L, around 10 crore rupees impact additional on the P&L and it's all representative of 1 month. Largely 1 month and something beyond that. So that's how the generally Strides thing is been working out. It has given us a lot of scope to look forward to multiply. As you remember, I told the biggest advantage with the Stride portfolio is the skew which it has. Or in other words, there are a lot of uncovered markets. Those markets were our strength areas. So going forward, this is what we are trying to exploit. These are early days. I would need between 1 to 2 quarters to really transform all this into numbers.
Thank you. I'll be back in the queue.
Yeah.
Thank you. We will take the next question from the line of Aditya Khemka from DSP BlackRock. Please go ahead.
Yeah, hi. Thanks for the opportunity, sir. Amit sir, just a couple of questions for you. So firstly, if you look through FY19 now, FY18 was obviously a disrupted year because of GST. But on that low base in FY19, excluding the Strides business, what should be modeled as your organic growth in the India business?
So Aditya, till this point of time, we have refrained from giving numbers of the future. But one thing which we had maintained, that as soon as the disruption gets over, and just on the industry side, third quarter there were 2 catches in third quarter. Number one, people like us who has a lot of chronic share, actually had a very robust third quarter last year. Because during the demonetization time, the chemists and the pharmacies were all open for the older currency. Yeah. And that prompted people to stock in, especially the chronic therapies, for a longer period of time. Yeah. So unlike acute people, so you will find two kind of a result in this quarter. One, people who are largely acute, there the base effect will be showing up in this quarter. People who are largely chronic actually got a certain amount of advantage in the first 2 months of the last quarter. So that's one thing which is to be considered. The second thing is that if you keep out these disruptions and the second thing is that December, January, Aditya is now looking up. It seems that all those issues which we thought will be solved in the third quarter, that is post July, didn't went the way we were actually thinking from an industry perspective and also from a company perspective. But whatever December, Jan is representative of, seems that it's opening up. So that's the second important point. Now, if you keep the disruptions out, and as soon as we hit the second quarter of the next year, where the 7% base effect also starts kicking in, the industry, in my view, should grow at a high double-digit number, so high teen number.
Okay.
And as I have maintained from the meetings which we had by the time going to IPO, we will always strive to beat the industry growth by 30 to 50%.
Got it. And that's a fair response, Amit sir. Just to sort of drill on that a little bit more. So if the industry grows, let's say at 15%, the chronic therapy will probably grow at 18-20%, and let's say the acute will probably grow at 10-12%, right? So, and you being largely chronic, you should actually be benchmarked to the chronic therapies and not really the broader industry growth, right? So, I get that 30-50% more than the industry average would probably land you in line with the chronic therapy growth, or would it be faster than the chronic therapy growth per se. So will you be gaining market share within chronic therapy?
Look, my advice to you is, my humble advice to you is, let us not get little presumptions, because this is a new normal which will set up. So because, till the time we reach July, there would be certain things which have changed on a quarter-to-quarter basis.
Yeah.
So on a time which would have been regular, unabated about whatever has happened, I would have been happy to really give some color on this. But if you ask me, even I cannot stick my neck out and say what's going to happen in chronic acute, because again you are hitting a Jan, Feb, March, which was not as good in the last year. So there are a lot of moving parts. So my advice is, just stay course for some time, let the things settle down, and then maybe April is a good time to speak about what would happen in the next year.
Understood, Amit sir. The second question I had was on this Strides bit. So obviously, we have integrated company. Sounds like you have also chosen the therapy areas where you wanted to expand field force, as well as chosen the MRs that you probably did not want. And so that entire rationalization cum harmonization of the Strides bit is complete in this quarter?
So, look, there are two components of completion. One component of completion is what happens in a piece of paper. So, are the dealers appointed? Yes. Are the people appointed? Yes. Have they been trained? Yes. The second component, which is the execution component, that happens when people go in the field and start doing their daily job, and that is where the cultural integration actually happens.
Right.
So the first piece is all done. The second piece is work in progress.
And how long does the second piece take generally?
Look, if we are aggressive enough and having the advantage of not having too many people, and the size of the company, if you are aggressive enough, 2 quarters are a good number. I mean, good time to actually turn this around. Got it.
So if I were to look at basically, Strides plus Eris in full force in terms of margin, in terms of growth, you would suggest that 2HFY19 is where I should focus more on, and sort of give you 1HFY19 to feel the things out and get your house in order basically.
No, I would not say this. So what I would say is the first quarter minus the 7% is a fair assumption.
Okay.
This is a fair way of looking at things. Only thing for the entire industry, April, June will still carry that 7% effect, which will then wean off post-July.
Yeah.
So adjusting for 7%, things should start looking up from the first quarter itself. And the second quarter, the adjustment goes out, and then everything becomes clean as it was at some point of time.
Yeah, it becomes like after that.
Yeah.
And I know again, Amit sir, I don't want to really push you too hard, but I know we refrain from giving margin guidance and everything, and there was a lot of talk around margins when we acquired Strides as to, what sort of margins we can get out of that acquisition. But just to sort of get a more qualitative feel around it, I don't want a number, but a more qualitative feel. So what we saw, let's say when one of your peers acquired, a bunch of brands from another peer, say if your peer was doing 40-50% EBITDA on his own business, he was able to, sort of reap out 65-70% EBITDA from the acquired business. The moot point here being that he could increase his EBITDA margins on the India business with the help of the brands that he really acquired. Would it be fair to make a similar assumption, not in terms of number, but in terms of direction, that let's say if your business does 35%, 40% EBITDA, and then the acquired entity, upon full integration, can give you, more than 35-40% EBITDA?
So clearly, Aditya, that is what we have articulated. So, the kind of work which we are doing, look, historically, if you look at the deals, we'll find hard to have a deal wherein, the brands are shifted from such a large field force to a comparatively a very small field force.
Yes.
And this is all where the productivity actually kicks in. So if you look at the number of people on both the side of the quarters and then compare the productivity, the answer is in the numbers itself. While you see the numbers growing up significantly, but the productivity is still where it was, more or less.
Okay.
So that means that any extra sale which is going to come in is all going to sit in the productivity. And when that happens, what you are saying is the ideology where we went through.
A fair point. And last question from my side is on the capital allocation, Amit sir. So far we have been very disciplined as I see it. We have been reinvesting whatever money we get from the Indian business into the Indian business. Strides was again an example of that itself. Year time, maybe a year, maybe 1.5 years, then debt, whatever you had taken up, will get wiped out. I'm sure even today you are net cash or very close to zero cash or zero debt. But in a year's time, you'll generate more cash to wipe out whatever gross debt also you have. So what's the next move then? I mean, where is our next bunch of capital going? Once the Strides debt gets wiped out.
So you're drawing me again to the future, but yes, on an indicative level,
yes.
Look, our limitation is not capital. Our limitation at this point of time is how much time do we have, what is the kind of our bandwidth, and how much time we could invest in these kind of deals. So clearly, as you said, from a debt level, we are zero. I mean, if it is one-time EBITDA in the future or whatever happens, it's completely okay. But that's not a problem area. The problem area is because we have chosen things which needs a lot of work. Yeah. And we are trying to turn it around so that the productivity gain happens. And that is going to be the philosophy. So it's more about the time management. So once we have the time in our side, the day we get confidence, okay, we can move up from this particular thing and this will have a certain amount of trajectory, then we will see. But there is no change from the thought that we remain committed to be invested in India. And once we are fully integrated, once we see the results coming up, not only in indication but also in numbers, then we will once again see that, where we can do the same thing again.
Got it. Understood. And again, sorry to squeeze in one more, but given that, you are well understood by the industry to be somebody who's keen on acquiring products in India or brands in India or companies which are India focused, and given the current difficulties that many of the smaller players are seeing in the domestic market, are you experiencing a lot of deal flow? Are you experiencing bankers walking up to you with a lot of propositions? If so, are the valuations on those sites more reasonable than what you have seen in Strides, or are they on similar lines?
So right now in the zone which I'm not looking at anything else, because even if you look, you do nothing. So that becomes more of a hobby. So I'm refraining myself from that. Once the right time will come, then once again we'll start looking. But the scenario, what you are saying, I presume that nothing must have changed between September, October when we were looking in this deal to today, January. So more or less it remains there. But I have no experience after Strides, so really can't comment.
Right. But valuations you feel would remain at 2.5, 3 times sales for subscale businesses like it was with Strides.
Again, it has to be very individualistic. If it is 3 times sales, then you also consider it is actually EBITDA negative. If it has good EBITDA, then it moves to an EV EBITDA level. So that all depends upon an individual company. Generalization from a 3x, 4x to sale, I actually don't believe in that much.
Oh. Thanks a lot for answering my questions, Amit sir, as usual, and all the best.
Thank you. Thank you.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. We'll take the next question from the line of Dheeresh Pathak from Goldman Sachs. Please go ahead.
Yeah, hi. Thank you for the opportunity. I missed the opening remarks. I'm not sure if you already called out, that in the published numbers, how much is contributed by Strides, if at all. So if you can just highlight.
Yeah, Dinesh, so in the published number, there is a non-significant extra contribution from Strides. Whatever billing in Strides which we have done is only to see that the channel is well filled up. As you know, when you do such a big churn from a distributor point of view, while the distributor themselves always had maintained 35 to 40 days of inventory, in such cases the inventories have historically gone up, and then there is also a lot of inventory sitting at the chemist level, at the tertiary level. So you can consider fairly that on a quarterly basis the impact of strides is far too insignificant to really talk about that. Next quarter onwards, we will see the strides number coming in.
So next quarter will be first full quarter, and you will consolidate for the full 90 days?
Yes, absolutely.
Okay. And there is one-off other expense as mentioned in the release, right? 3.5 crores of one-off cost in other expense in this quarter, correct?
Yeah, Sachin will tell you though.
Yeah, that expenses is pertaining to the acquisition of strides.
Okay.
So those expenses are like one-off expenses, not an operating types.
Okay. And can you also adjust it for because the base is not properly adjusted, can you just give me like-to-like net of excise, 9-month numbers for standalone and consol for this year and last year? Just the absolute numbers, so that we can do our internal math.
Yeah. Dinesh, if we send you offline, will you be okay?
Yeah, that'll be okay.
Calculation I think we have to do. We'll send you offline.
Okay. Okay. Yeah, I think that is all from my end. Thank you so much.
Thank you, Dinesh.
Thank you. We will take the next question from the line of Natarajan, individual investor. Please go ahead.
Good afternoon, Amit. My question is about the third for the recent quarter. The numbers and you sort of alluded to what had happened. I mean, you were caught up in the integration of strides with Eris. Now, can you just provide in brief how you expect the coming quarters to be, and do you expect the numbers to be in the consolidated numbers?
So, I will say the same thing again. Sorry for that. We have never been talking about the future numbers. But to briefly indicate your question that whatever strides sales which we have captured, which we have got rather, would be captured in the first quarter. Now, stride sale to our base sale has been in the excess of 20-25%. So naturally, that's something which is going to come in the first quarter. And plus the base sale growth. So these two would be the components which we will be reporting full time in the fourth quarter. Also remember that historically, fourth quarter is the weakest quarter for us because March is a month where a lot of destocking happens at the stockist at the chemist level. So, but it is absolutely captured in the last year also. So there is nothing new there.
Okay. So, okay. The second question that I have is, so would you, the growth that we saw for Q2 of this year vis-a-vis last year, and obviously there is some decline compared to this one. Now, would you attribute that to the disruption caused by Demon?
Yeah. No, my sincere advice is that for this year, when there had been so many things happening altogether, it would be advisable to look at a 9-month number rather looking it from a quarter perspective. You rightly pointed out second quarter was a post-GST quarter where the pipeline got filled. So that was the reason why the second quarter had such a peak, and it has fallen from the peak just because that got normalized. So this is how the whole year had been.
Okay. Okay. I'm finally, I'm going to push my luck. You said, I know you've said that you're not going to be able to give guidance, but would it be reasonable to assume about a 20% CAGR over the next, let's say, 3-4 quarters from now?
So when you say that 20% for 3-4 quarters, then you are discounting two things. One is the base sale growth, and the other is the growth of the acquired portfolio. And we are all working very hard on both of these aspects.
Okay. I'll be glad to be proved wrong then. Okay, all right. Thanks, Amit.
Thanks.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Anubhav Agarwal from Credit Suisse. Please go ahead.
Thank you. Amit sir, can you just quantify the strides contribution this quarter? I know as you said it's non-significant, but just to compute the base business growth, we need that number.
Anubhav, I would rather advise you to start this exercise from the next quarter. Because
can you alternatively tell us that like to like, how did your base business, standalone business grew? Just the standalone number.
Say that. No. I mean, you're asking the same thing. Anubhav, I know I'm not as good at math, but I've been learning with you guys. So.
No, sir, this is a very fair question. I'm just asking nothing great, but how did you?
Anubhav, I will explain it to you. What I told in that long prelude, that it is not about the numbers. Please try and understand that we have added almost 500 distributors. So what do you do when you add 500 distributors? If you give them what they want, it just goes crazy. So it has to be very, very well crafted, well curated, sales which you need to get out. Because there is a law. The law says that if I want to incorporate Strides distributors, I will have to give them Eris stock also. Now, if I open, 50% of what numbers with what we have done over the last 10 years, it just causes a mayhem. Therefore, one has to be very, very pragmatic about that to make sure that there is not too much of pooling in the market. It destroys it disturbs the apple cart. That is the reason, because there had the driving factor has not been Stride sales or Eris sale. The driving factor had been how do we basically integrate these large number of distribution. So that is the reason I am telling you. You just understand what I am saying. If there was no Strides, have the number been very different? The answer is no. Now, whatever is the contribution is all being made in a way so that our channel remains robust.
Okay. So let's put a zero number for Strides this quarter. Then adjusted for 7% impact, our base business grew by 13%. Was that the right statement? Or is it a double-digit growth for your base business this quarter?
Anubhav, I think I have said enough on this, and it's the reason why.
I'm trying to understand this. So let's say you add more distributors, you don't want to sell a lot of stuff to them, but what about 1,100 distributors which are active? So I'm just trying to understand, nothing great. I'm trying to understand how our business did.
No, this I can answer, because this is absolutely logical. So what you have to do, even in the existing stockist, you will have to control. Otherwise, if you don't control this side and add new one, it just creates a big mammoth. So that's what the exercise had been. So the question in our mind was not about how much do we sell this or that. The question in our mind is that how do we integrate these large number of stockists and still keep the inventory in control. So that's how we have worked. So if you ask me, I can tell you the number. If you ask me what happened to that 1,100 distributors who were our original, we didn't supply them what they wanted.
Why wouldn't you supply them what they wanted? Because the inventory was already normalized for them. So you did not supply the Strides stuff to them.
Yeah. So we didn't supply because, otherwise what happens, Anubhav, 7-9 division, even if you start 2 boxes, 3 boxes of each SKU, it piles up to 3 lakhs, 4 lakhs. So you have to be very careful on that part. And that is very important for the business to run smoothly. So we have done all that adjustment, so there is no problem. And we have passed through. This is a December story. We have done the January closing, so we can comfortably say that fairly well we have integrated this, and January is already closed.
Okay. So just moving on to next question, sir. What is the field force size now, as of now?
As of now, let me tell you. What was the number?
Consol 2070.
So at the consol level, Anubhav, we have moved to 2070.
So this is versus 1500 last time, right?
Yes.
And just clarity on when you mentioned you have added 130 new reps on your own on the for the new division of CNS, what product are they promoting, 130 reps?
So, okay, I'll tell you this. Anubhav, what happened, we got a lot of brands from Strides. The top brands we actually mentioned, the Sirlift was one top brand which was featuring in psychiatry, but they also had a lot of 2.5 crore brands. So there was a Livaroxa which was there, 2.5, 3 crores, but a prime therapy in neurology. They also had 2 more anti-epileptic. Again, prime therapy, but the size was 2.5 crores. It gave us an advantage of launching an entire division and bring all these brands together. So if you ask me from a neurotherapy coverage, our neurotherapy coverage has gone, quite a bit, very big in fact. These are all 2.5 crore brands which were not doing well in Strides from a growth perspective. They were the second or the third league brands. We took an opportunity to put this brand into a new field force so that once, if we presume that we grow our neuropsychiatry business well, so the growth will not come from the 2 top brands which earlier, people would have thought of Jinko Sir and Sirlift alone. It will come throughout from all the brands. So that was the opportunity in front of us. And we thought, and I personally think that we actually seized the opportunity by putting 130 people extra and expanding our first division 65 to somewhere 110.
Okay, so it says 65 you already had in CNS, that's what you expanded to 110.
And one more division we got of 130.
Yes, so just asking, so how is it different from saying, so from Strides you took about 250, 300 people. So this is like another way of saying that we are adding another 200 on top of that, right?
So it's a long story. So if you want to know that how these 500 are coming, I will just explain it to you.
Yeah.
So 60 people we hired in one division, 130 plus 40. So 170 we hired in one division, 45 we added in one division, 62 we added in one division. So because this portfolio is now sitting across, so that is how one by one we have added this.
Yes, so this match is clear, sir. There's no doubt. I was just trying to understand that when Strides was promoting this portfolio with 500, 600 or 600 plus people, that's what we mentioned last time, and now we took
1,200 people and above.
I'm sorry, sir?
Strides were promoting this by 1,200 people, 1,200, 1,300 people.
Oh, is it? My sense, okay. Last time, probably I remember wrong number, 600. So I'm trying to effectively, with the strategy that we have, that with this portfolio, we want, so 180 crore sales, we may think that it may grow at very high pace, but we want to promote with roughly about 500 people. That's the game plan that we have right now, right?
No, it's little dynamic. Just hear me out for a moment.
Sure.
What happens? Suppose we were a gynecology team of 160 people, which was promoting women's health, Montana. We took Raricap because Raricap came and we thought that this can further add up. We added around 50 people in that division.
Okay.
The division was already there, 50 people were added so that we are able to give enough reach and penetration to Raricap in particular. So that's how it happened in different divisions, because the portfolio which we took from Strides is not sitting here as a Stride portfolio. It has been distributed in the front-facing division for each therapy, and that is how the growth in number of people have come.
Understood. That's clear, sir. Now, just one question on the expense item. Other expenses this quarter was very, very low actually. Even adjusted for the one-off of 3.8 crore expense, we were doing other expense now is just 38 crore in this quarter. I think lowest we have done so far. What's the reason why the expenses are down so much?
So look, it is logical now, but what happens when you integrate these people in your team? The basic work which is in front of you starts from training and reviews. So you spend most of your time in integration rather than promotion. Do you get my point? So what happens? Suppose there is a gynecology division. Now there is a new brand which has added, and there is a new number of people they have added. So you go back and have the responsibility of training 200 people once again for the new brand, the strategy for the new brand, the listing for the new brand. These are all the work which happen. So therefore, promotion takes a back seat and integration takes a front seat. Other caveat is, if you look at the last quarter our expense were around 75-80 crores. So expense is something wherein you look in from a little 2-3 quarters point of view, it gives a better picture. A 9-month picture will give you a better idea. On a 9-month basis, we might be 5-10 crores more than what we did last year.
No, but actually, no, my question was that I'm looking only at your standalone numbers. So the new guys, I can understand they were not doing promotion but integration. What about the old guys?
But guys, all these guys went into the same team. Now we don't have a different team. Okay. So these 50 people who went to gynecology team, the entire team had to be then reskilled for the new brand. The training happens, the strategy meeting happens. It doesn't happen for those 50 people. Those 50 people get integrated to 160 people. Now there are 210 people who will sell Raricap and Autogesic. So they need to be trained on Raricap and Autogesic. So this is the work which you do more aggressively. And that's how it always pans out.
Okay, so just last question I have on this, on our facility. Now, this is related to Kinidex and MA also, but generally in this quarter I have seen external purchases for us were very high in this quarter. And I was seeing that for Kinidex and MA also the margin, let's say, for them, and they will be largely unaffected by what's happening at Strides or integration. There is no progress on the top line or on the bottom line for last 2 quarters there also. I don't see any sourcing being done for them, any change over there. So just wanted to understand very high external purchase in this quarter and what's happening in Kinidex and MA.
Okay. So I can tell you about the one part of the question. The second part of the question Sachin will answer. As far as you said that there has not been a top line growth in both of these entities, which is clearly mentioned in the which is clearly visible on the paper. So what happens, Anubhav, that whenever we buy anything, almost 30%, 35% of that is something which is not very healthy to promote and take it forward. So you see that number coming down and then the core portfolio growing up. So 30% of the sales which we got from Kinidex was not the sale which we would have liked to grow and continue. So that's something which you always take a call upon. What grows, so you remember there's a weight loss and there's an inch loss. Maybe inch loss comes first and the weight loss comes second. Same way when you do these kind of buyouts, it's the portfolio prioritization which happens first and then the numbers come second. So the core brands in Kinidex have been growing decently. Right? Not the way we would have thought, because a lot of disruption in this entire year. We couldn't achieve what we thought we could achieve of Kinidex from a top line growth point of view. Having said that, whatever we can achieve within Kinidex is about the major brands. So if you look at the major brand contribution, which when we took was around 60s, now it is in 80s. So that's a good job which has happened. The point where the sales have not grown to the level which we would have thought, I completely agreed. We at least wanted to see 5-6% more. Also remember, Kinidex sells a lot of nutritional product. So under GST, some of their products went into the highest slab of 27, 28, whatever that percentage was, because it was nutrition supplement. So there has been a lot of back and forth there. So we had to reapply for the licenses. All those things happened post GST. So these were 2-3 things where the Kinidex sale is not satisfactory from a top line perspective. But within the sale, this is all good things which have happened, which I have told you.
Helpful. Just on the facility front.
Yes, facility-wise, I mean, if you see, we are operating at 65% of the capacity utilization on a single shift basis in Guwahati.
Yeah, so my question, Sachin, was that in this quarter, if you look at standalone numbers, there was very high external purchases. Like we were doing roughly about 8 crore kind of, 9 crore kind of purchases per quarter. Now this quarter there were 32 crore external purchase.
Mm-hmm.
What will be reason for such a high purchase immediately?
Quarter, it's also the stock that has come up in the time of the acquisition of Strides.
Or this is just the acquired stock from Strides? That's what the number is.
That was entirely third party. There's no contribution of Guwahati into that. So the out and out acquired stock.
I have the comment that there was Stride sales will be very low, right? Or it is just sitting in inventory.
It was a part of it's sitting in inventory. It was a part of the deal only.
Yeah, so the part of the deal was that we will take all the stock which they have and also all the orders which they had placed till that point of time. The second part of the deal was all that we will take from them, even the last batch, if it gets expired, it will be reimbursed by Strides. So this is how the deal was made. So we had to take all the stocks, even knowing that some of them will not be sold because of different reasons. But the comfort is that our deal clearly mentioned that all expiries which would happen till the last batch, which we took from Stride, will be a responsibility of Strides.
Okay. Thank you, sir. Thank you.
Thank you. We will take the next question from the line of Ashish Thakkar from Motilal Oswal. Please go ahead.
Yeah. I just one bookkeeping question. What tax exemption could we take for FY19 and 20 since we have Strides in our portfolio now?
Ashish, I'm sorry, you're not able to hear you. Can you be a little soft, please?
Yeah. Sir, can I have the tax assumption for FY18 and 19 since we have different tax in this quarter?
I'm sorry, we are not able to hear you. Be very, very soft. It's just amplifying.
If you are on the headset, you will need to take that off. You will need to use the handset to ask the question.
Yeah, so you can hear me now?
Yeah, it's still very loud. It's breaking up. Can you be more soft, please?
So I'll get back in the queue.
Oh, sorry for that.
Yeah.
So we'll take the next question from the line of Prakash Agarwal from Axis Capital. Please go ahead.
Yes, thanks. Sir, just wanted to understand how is the inventory days move from what we saw low in September to now in December?
You are talking from the market data point of view?
For Eris as a whole?
No, you're talking about from the marketing data or our internal?
Internal or, whatever you can share.
Market data, Prakash, we haven't looked through. Internal also, I think, Sachin, have you done that math?
26 days.
So Sachin tells me that we are at 26 days.
Our inventory.
Versus September, sir?
September 28.
It has gone. It should improve, I think.
Huh?
It should improve, inventory days. All companies are saying that there is marginal improvement from September to December as GST.
It has moved from 26 to 28, actually.
26 to 28?
Yes.
Okay. Hello?
Yeah.
Okay. And, sir, the cash and the debt position, please?
Sachin?
So the treasury that we have is around 302 crores. Hello?
Yes, sir.
Yeah, the cash that we have as treasury is 302 crores approximately, and the debt is 400 crores.
Okay. And also, if you could help us, is there more cash?
No, the 302 crores is what we have. As of
including the liquid investments and the fixed income securities and the liquid cash.
Everything. Entire treasury is 302 crores as on 31st December. And the debt is 400 crores. And the first installment that has to be paid is coming in Feb end.
Okay. And also, sir, if you could explain the deferred tax, that 8.2 crores.
See, deferred tax is because, if you say Strides portfolio, as per income tax, you get 6 months, whether it is post-September, right? So you get 6 months for depreciation for income tax purposes, right? And technically, if you half it up, we have 3 months of depreciation as per income tax in quarter 3. And if you say as per books, it's only 30 days. Hello?
Okay.
Difference of period, 30 days vis-a-vis 90 days approximately. The second is that as per income tax, we depreciate it by 25%. As per Companies Act, we depreciate in 50 years. So there is a huge gap between the depreciation as per income tax and depreciation as per Companies Act. For that, you have to create DTL. So that DTL is approximately 8 crores for the quarter 3.
Okay. Understood. Thanks.
Thank you. We will take the next question from the line of Mithilesh Sahani, individual investor. Please go ahead.
Yeah, thanks again for taking my call. Whilst a lot of it has already been answered by you, Amit, with respect to the integration of Africa as well as Kinetics, given that we are already 1.25 years into the acquisition, can you please throw some light on to how the portfolio of UTH Healthcare is doing, and do we have any presence for brands outside India also, somewhere in the African market for these brands?
I'm sorry, I missed you. Can you please come again?
Yeah, no problem, Amit. So my question was with respect to basically the subsidiaries we have. Whilst we have answered already on Africa and Kinetics integration and your view going forward, can you throw some light on the UTH Healthcare acquisition and integration and going forward the scenario you see on the same, and do we have any brands which have presence outside the Indian market also in African markets for UTH Healthcare?
Yeah, so second question, the answer technically is yes, but it really doesn't move the needle at all. So it's very non-significant, absolutely insignificant rather. The first question which you said, what did we acquire? So we told at that point of time that Youth is one company which was first of the block trying to create a niche for themselves in nutrition. We are chronic people. We think we understand nutrition quite better, and we would like to scale up. So that was the point with which we have taken. We took this. So we have integrated some part of the Youth. Some part of the integration has started right now. So in quarter 4, the running quarter, we are launching one division which is only a nutrition division with around 35 people across the country. Any color would actually come in the first quarter of the next year, at the end of the first quarter in the next year.
Sure. And has the portfolio of UTH, like in case of Kinetics, has also been impacted due to the high GST tax rate?
Yeah. Some of it, yes.
Okay.
Thank you.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Anubhav Agarwal from Credit Suisse. Please go ahead.
Yes, just one question of clarity of what you mentioned in the press release. There is a remark that in transition to GST, Eris has changed the incentive structure which will have impact on sales return. Can you just explain this?
So what we have done, Anubhav, is post this, I think the current financial year, what we have done is we have in our incentive structure to the employees. Hello?
Yeah.
So there is a higher weightage of expiry returns. So if any expiry that comes back, it has 200% more weightage in their incentives. Negative weightage.
So this is now you double the weightage. That's what you're trying to say.
Yeah.
But what has to do with GST, or is it just has it something to do with GST which brought about this change, or this you wanted to do and this was just an opportune time?
Yeah, this is an opportune time to set things right.
Okay. Thank you.
For us, for an employee, that much is a very, very huge amount.
Sure, I can understand that. Thank you. Thank you very much.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. We have the next question from Prakash Agarwal from Axis Capital. Please go ahead.
Yeah, thanks, sir. Sir, just, earlier participant, Ashish, asking about the tax rates. So since we had this deferred tax impact this quarter, tax rate is really low. What is the outlook for this year and for the next 2 years?
Tax should be in the range of 8-9% on a consolidated basis for the next year.
Okay. And this year obviously is going to be lower because of the strides.
The strides because of the depreciation and because of the interest.
Okay, thanks. And one question for Amit sir is on the, the base portfolio, that is the diabetes and the cardio, which has been the, the key growth areas and the key focus areas. And obviously the turnaround is a separate segment.
Correct.
These are obviously, as you said, aberrations which has happened and the large base in Q3. Just wanted some color on what are the, the new products, brands that are at a fledgling state and which you are seeing as a, our novel point being bringing first products in the market or, something novelty so that we get a lot of scale and traction with the doctors, specialist doctors. So anything in the last 3, 6, 9 months, any initiatives that we have taken on that count?
Yeah, Prakash, there has been a couple of things on that count, and there are a couple of discussions also happening. I think by the time we sit again for the call next quarter, there would be something substantial to share. As of now, we have done something, but they are not very significant in terms of either their size as of now or their market opportunity. So, I mean, we can leave it there. But there is something which in this quarter might come up which is significant, which I will inform you when we sit for the next time.
Perfect. And lastly, on the MR addition, correct me if I'm wrong. Around the IPO time, fiscal 17, we had about 1,500 people. Middle year, September 17, we added about 100 to 1,600 people.
Correct.
And now with strides and some additions in a few of the divisions, we are at about 1,900 people.
Yeah, a little more than that, 2,000.
We are around 2,000 people.
Yes.
And the impact or the productivity, obviously, next year, I mean, currently they are hired and the sales are low. So the MR productivity for the next 2 years will significantly improve for where we are.
Yeah, definitely. But also keep in mind that, we also have a sales which we have brought. That is the stride sale.
Yeah.
So that will not allow the productivity to drop down because, that sale is not, no specific people have been hired for that. They are all doing joint work, joint brand promotion. So it will sit across the division, across the company, sorry. So what typically, if, I would have added 600 people, Prakash, without having strides, the productivity would have gone down to a very different level. But because this sale is coming up, and if it grows, we might see a time where the productivity has a chance of actually inching up, even at a larger base.
Understood. So the two big levers that I understand which will play out, A is, your own portfolio playing out with a much larger field force and strides portfolio which was under-penetrated going to pan-India level and adding up to the leverage. These are the two bigger ones, and the additional distributor that you spoke about, the 500 distributors which are A category mostly, will add up to the large quality of growth. Yeah.
Absolutely. So just to give you an example, say in a place like Bombay, suppose we inherited X sales from strides. Just 1 month, January down the line, I can tell you we are X plus 10%.
Okay. So basically 180 crores is what we got and divide by 4 if we do. So we are already seeing...
These were weaker areas actually, Prakash, where we got a lot less sales actually. These were the weaker areas. As you remember, South was a very dominant area. So if this cycle continues, then we see that pan-India playing out which we had thought about.
Yeah. Yes. Okay. And last question from my side is Q4 you mentioned obviously for most companies and yourself is softer because of the destocking or the March ending quarter.
March ending, yes.
Yeah, March ending quarter. I see, adjusting for the last year number 9 months and Q4 of last year, the gross margin and EBITDA margin has also fallen. I mean, why would that impact? I'm not able to understand.
Sales down, Prakash. Sales comes down, then 80% gross margins, 85% gross margins. It will have an impact on EBITDA.
No, EBITDA I understand. Gross margin, I mean, if you see last 9 months is 85% plus, and in Q4 of last year it dropped to 82.
Kynedex. Last Q4 we took Kynedex, no?
Okay.
Yeah, Kinetex, when we took, it was, 62% gross margins.
Okay. So, assuming all things similar, obviously we'll see an improved gross margins.
Look, we will see an improved gross margin because this number which you are seeing is the stock which have been brought from Strides. Right, at a price which we couldn't negotiate because, this is the price which we quoted us. That was the price which they have made it.
Right.
The same portfolio, when we shift to Guwahati and third party from our own loan licensing agreement, Kaushal has given me a lot of comfort that there is a huge room for a cut there. So, this price which you are seeing, the gross margins on these products which you are seeing is clearly a one-off. It will settle down in the coming quarter.
Okay, perfect. Perfect, and all the best.
Thank you, Prakash. Thank you for the call. I hope we are done with it.
Ali?
Participants, to ask a question, you may press star and 1.
Can you please, I think we are done, Prakash.
Yeah, he will just announce that.
Yeah. Sir, there are no further questions in queue, so I would request the management for the closing comments.
Yeah, thanks for taking our time on a holiday especially. And this is what we all had to say. Thanks for your patient hearing. And look forward to catching up again in the next quarter meeting. Thanks for taking our time once again.
Thank you. Ladies and gentlemen.